business income, that is in salaried person or income from other sources, house property, etc. They are allowed to exercise this option year on year basis. That is along with the filing of return. You can opt for this scheme. Mandatory scheme is a new scheme. If you want to opt out of this, you can go to the older scheme. In the return itself, the provision will be made to opt for that scheme, and year on year basis, it can be exercised by those SSCs who are not having business income. So this has to be difference between both person having business income and those who are not having business income. Now, what are the benefits of this new tax regime under section 115 BAC? The basic exemption rate, which we all know, it was 2,50,000 rupees. This is the last assessment year. It has been enhanced to rupees 3 lakhs. Slab rates have been changed. There is also a change in the maximum surcharge, where total income of an SSC exceeds 5 crores of rupees. The maximum surcharge applicable was 37%. Now it has been reduced to 25%. If we see to that, the 12% reduction of surcharge rate, it will be beneficial to high income SSCs only, those who are having income of more than 5 crores of rupees. So for the smaller person, it's not much beneficial. For higher income, it is a beneficial. And rebate under section 87A, it has been enhanced. You know that until last assessment year, rebate of 80 under section 87A was applicable till rupees 12,500. That is, when income of SSC is having up to 5 lakhs of rupees, the tax liability was 12,500 rupees, and the rebate under section 87A was applicable as to that 12,500 rupees. However, if income is more than 5 lakhs rupees, the rebate was not eligible and the SSC has to pay the tax. Now it has been enhanced the rebate to up to 25. That means the income up to 7 lakhs of rupees, if you are having SSC, then rebate under section 87A tax liability is coming out 25,000. Thus rebate is eligible and there will be no tax liability for the SSC of person having income up to 7 lakhs of rupees. Similarly, if the rebate is not available, if the income exceeds 7 lakhs of rupees, that we have to consider. One more beneficial provision for this proposal in this budget is that standard deduction of 50,000 is been allowed to the salaried persons in this new tax regime also. Earlier it was not available. This year they brought that standard deduction of 50,000 is also allowable for the salaried person if in new tax regime also. Now, comparing the new slab rates, what are in this budget, the net income up to 3 lakhs of this tax liability income from 1,000 to 6 lakhs of rupees. The tax income rate will 5% on income which exceeds 3 lakhs of rupees. That means from 3 lakh to 6 lakhs, the amount will be 3 lakh rupees. On that, 5% will be chargeable. Subject to, we have seen that up to 7 lakhs of rupees, there is a rebate available under section 87A. From 6 lakhs, 1,000 to 9 lakh, the tax rate will be 15,000 plus 10% of the income more than 6 lakhs of rupees. And similarly, from 9 lakh to 12 lakh, 45,000 plus 15% in more than 9 lakh rupees. And 12 lakh to 15 lakhs, the tax is 90,000 plus 20% of income more than 12 lakhs rupees. So this chart will be available with you. So this is the chart of new slabs available provided in this budget. And above 15 lakhs, 1,50,000 and 30% of income more than the 15 lakhs of rupees. Similarly, if compared with the old slabs, the old slab, what I said that up to 2,50,000 there was no tax liability, basic exemption limit. From 2,50,000 1 to 5 lakhs of rupees, 5% on income which exceeds 2,50,000. As we said that it comes to near around 2,50,000 for 12,500. Rebate was eligible for that. Now it is enhanced to 25,000. 5 lakh to 7,50,000. The slab rates have given 12,500 plus 10% of income more than 5 lakhs of rupees. And 7 lakh to 10 lakh, 37,500 plus 15%. On 10 lakhs to 1250, 75,000 and 20% of more than 10 lakhs. Similarly, 12 lakh 50 to 15 lakhs and above 15 lakhs, 1 lakh 75 plus 31. So these are the two differences between the applicable rates. If the example we consider that today, if an SSC is having a total income of say 7,50,000 rupees, so under the old scheme, if you work it out, the liability will comes about 37,500 plus education cess. And if you compare with the new rates, the liability for this SSC will be reduced to 30,000 only. So it is beneficial for such to go for, it is net saving of 7,500 rupees for the new scheme if you are going for this 7,50,000, because up to 7 lakhs there is a rebate, but however it is crossing 7 lakhs, the rebate is gone, but the slab rates are changed. So beneficial of tax is there in this scenario. Moving ahead for the changes in surcharge which have been proposed by the budget, where the total income is exceeding rupees 50 lakhs but does not exceed 1 crore rupees. The surcharge in old and new rate is similar of 10%. When the total income is exceeding 1 crore but it does not exceed 2 crores, the rate applicable is 15% in old scheme and new rate also no changes. And the total income with excluding dividend income, short-term capital gains covered under section 111A or long-term capital gains 112A exceeding 2 crores but not exceed 5 crores, then the surcharge applicable is 25% in both old and new rate. The major change here is that the total income when it is exceeding 5 crore rupees, and its income should not include dividend income, short-term capital gains under 111A and long-term capital. The rate earlier was 37%, now it has been reduced to 25%. So this is a beneficial provision as we discussed earlier also to high income assessees who is having income more than 5 crores of rupees, and other income, total income where it is including dividend income and the short-term and long-term, the rates of surcharge had been same. Now, just to consider an example between new tax regime for a salaried income. Consider as an example, earlier 2,50,000 tax was nil, and for 3 lakhs also it is nil because the basic exemption is now 3 lakhs of rupees. If the total income is 20 lakhs of rupees and the SSC wants to claim all those deductions of standard deductions, profession tax, PPF, mediclaim which are eligible under the income tax provisions, say it is claiming of about 8,60,500. So the tax liability for that, and after claiming all deductions, it will come to 1,53,750 near about. And similarly, if the same 20 lakhs of income, if is not claiming any deduction and mandatory going for this new scheme of tax regime, then his tax liability will 2,85,000. So in this comparison, we say that near about more than 1.27 lakhs rupees saving can be done by the SSC having income of 20 lakhs of rupees by claiming the deductions eligible under the provisions of the Income Tax Act. So old scheme will be beneficial if we compare to both these schemes. Now moving on, if the salaried person is having income of say example 75 lakhs rupees, so same after claiming all those deduction eligible, his tax liability will be 18,03,750. But if he doesn't opt for that old scheme and he is staying with that new tax regime without any deductions to be claimed, then the liability of tax will be 19,35,000. Still in this scenario, we consider that claiming deductions, if all are eligible, then it is beneficial to stay with the old regime and not with the new regime. So as we know that it is optional, so salaried income are given an option to decide the same grant take out, continuing with the new option scheme or going out at the time of filing of return itself. And this can be changed year on, every year you can decide whether old scheme is preferential to me or new scheme is preferential, that is without deduction or with deduction. The lower of income tax, you can opt for that option in the return itself. Now moving ahead, further provisions which the government has been provided in this budget, starting with that. Hello.
सर आप वो स्लाइड शो स्टार्ट कर सकते हैं प्लीज, हम बस टाइटल्स भी देख रहे हैं.
It is started ना slide show.
we are just watching the
No, sir.
titles.
It's not coming.
The screen is visible, but you
Yeah.
are just on slide only.
Acha, no, I'm in my screen. It's showing this new slide up to 11 number.
No, sir,
No.
we are on just first slide only.
No, sir. We have the first one also.
1 second. Huh?
Please.
F5. Now consider the sharp shade only. Now it's moving.
It is on the second slide now, but yet slideshow mode is not on.
1 second. Actually, I want that slideshow.
सर वहाँ पे नीचे भी एक बटन रहता है स्लाइड शो का.
Yeah, I have clicked on that only. Slideshow button. Now whether it's moving, because in my screen I am able to see it's moving.
No, here it is not moving.
1 second. Huh? Screen sheet move करती थी. Screen only के move नहीं दे सकते. How to do this? They are not able to see. They are in the first screen. Slideshow move नहीं थी. Telling the pato का. Now it's moving. Hello.
Sir, it will not automatically move. You need to click every time after finishing.
Yeah, I'm clicking, but in my screen it's showing that it's changing. I'm on the sheet number 11 now, but it's not showing on your screen.
Yes, changes in tax rate, that slide. Now we are seeing that slide.
Now,
Same slide.
which slide you are being able to view?
Changes in tax rate.
Second slide, I think.
Only second.
Yeah.
Because I am on 11 number. 1 second, I will again update.
Now it's 11.
Now it's 11.
Yes.
Again, same mode.
Now it's 11. You can easy to see.
Yes.
Yes, but there is no color, sir.
Acha.
No.
Slideshow.
PPT mode is there. It should be slideshow mode so that it should be visible properly.
Now,
Nothing happened.
you just do one thing. Again, reload this. 1 second. Give me 2 minutes.
Okay, sir.
1 second.
It's perfect, sir, now.
Now it's visible.
Yes, sir, it is proper now.
Now the changes has been visible.
Yes, sir. Conditional tax rate slide is going on. Now comparison slide has come.
Now,
Rates of surcharge.
okay, 1 second. Now this one, which slide?
Concessional.
Okay.
11th
So
slide.
now it's visible. Okay. Now it's visible, no? Hello?
Yes, it is visible
Yes, sir.
proper.
11 number slide, concessional tax rates.
Yes.
Okay. So now, concessional tax, and the government has made to promote the manufacturing facilities and the cooperative societies. The new section 115 BA has been added to the Act, wherein a resident cooperative society can opt for this section. The conditions is that it should be set up and registered on or after 1st of April 2023, and also it should commence the manufacturing by 31st of March 2024. So it is confirmed that it is not, the society should not be an older one already in existence. It should be set up only after 1st of April 2023. It should not be formed by splitting up or reconstruction of an existing business. See, already society in existence, and they are splitting up a new some business separately for manufacturing and starting as a new. Then that will be not considered for this concessional rate of tax for schemes. And the society should also not use the plant or machinery which is previous. There's old plant and machinery use should not be allowed. It should be newly purchased plant and machinery. However, subject to certain conditions, imported plant and machinery are allowed. So in case of such resident cooperative society who want to opt for this 115 BAE, the tax rate applicable to them will be only 15% as compared to the higher rate applicable of 30%. So it is a beneficial provision for societies going for manufacturing activities and newly set up. Or further, they are also not applicable of section 115 JC alternate minimum tax. We all know that alternate minimum tax is tax where somewhere in the books of accounts there is a profitability, but while computation of total income as per Income Tax Act, after getting some provisions, deductions, etc., there is no tax liability. There is a provision of alternate minimum tax rate has to be paid by the assessee. So this section's provisions will not applicable for this resident cooperative society opting for this scheme of 115 BAE. Now moving ahead for the tax on winning from online games. Online games, we all know that during the pandemic, people were at home and many facilities of online games have been started. People from youngs to middle-aged group also were playing games online. The online games are which such are easily accessible to internet and computer resources. So now a new section has been added to this act, section 115 BBJ, wherein tax on winning from such online games is been made taxable. So that has to be considered in the part of the budget. Now moving further to income from salary, which we know salary income. We have headwise income. What are the provisions been provided by budget? We know that residential value of a residential accommodation which have been provided to the employees by the employer, either they are rent-free accommodation provided or they are provided as a concessional rate. So earlier we know that currently the rule 3 of the income tax rules 1962, it provides the methodology to compute the value of rent-free accommodation, and explanation to section 17.2 provides for the valuation of the concessional rate of that accommodation. So now in order to rationalize these provisions and to consider as a valuation of the residential accommodation, amendment has been made in the sections 17 to 1 and 17 to subclause 2. The value of this rent-free accommodation provided to the SSC by its employer, now it will be computed in such manner as may be prescribed. So government will be coming out with the prescribed manner how to compute that value of a rent-free accommodation, and for the same rules will be notified. Once it is become an act, the rules will be notified by the government. And similarly, 17 to the value of accommodation which is provided at a concessional rate, that has to be considered by the rules. Amendment has to be made, and the provisions for the same will be made by the government for that valuation, how to be considered as a perquisite under section 17, and it will consider as a part of the salary. These provisions will be applicable from assessment year 2024-2025. Now moving ahead to the tax benefits to persons enrolled under Agnipath scheme. We all know that Agnipath scheme was been introduced last year, finance 2022, wherein a Defense Ministry has implemented the Agnipath scheme 2022, which allows for the recruitment of Agniveers in the Indian Armed Forces. It became effective from 1st of November 2022. Hope the screen is visible to all. On page number 14, I am there. Tax benefits to
Yes,
person.
sir.
Okay, thank you.
Yes, yes.
So now, in order to put this Agnipath scheme, government has inserted new clause section 17(1) that the contribution made by central government to this Agniveer Corpus Fund account of an individual shall be considered as the salary of that individual. So whatever contribution is being made to that corpus fund, it will be considered as a salary. The scheme, I just brief, I am giving over the scheme that every Agniveer has to contribute 30% of his package monthly basis to his personal Agniveer fund account, and the government will also add equal amount to this Agniveer corpus fund. And additionally, government will provide interest on the subscriber's contribution to the account of the approved fund at the rate applicable from time to time, which will be decided by the central government. After the end of the 4 years engagement period, Agniveers will be received one time. This is called a Sevanidhi package. That will be his contribution plus interest along with contribution with the government. So now, in order to give benefits to that, if it is considered as a part of salary, then whether it is taxable in the hands of the provisions have been inserted. First, that it will be considered as a salary, but since it is not to be taxable, the contribution which has been deposited in Agniveer fund, it has to be, new section is introduced, section 80 CCH, where it will be allowed as a deduction. So it will be coming out of the taxable income. Total income will be not include this amount. The main benefit also available that even if the individual has opted for new tax regime, then also he is eligible for these deductions, because if we go in other tax other than this Agnipath scheme, new tax scheme, you are not allowed to go any deductions eligible for that. But this is a specific provision where they will be having the deduction under section 80 CCH. So now, similarly, whatever be the amount received from Agniveer Corpus Fund by a person or the nominee, it shall be exempt from income tax under section 1012C. The same is applicable from assessment year to 2023-24, because the scheme, as we had discussed that it is implemented for 1/11/2022, so it will be applicable for assessment year 23-24 onwards. So it's a beneficial provision to all those individuals who are taking part of this Agnipath scheme and joining as an Agniveer to that and serving the nation. Further, we move ahead to the leave encashment for non-government employees. We know that non-government employees are given exemption of leave encashment up to a limit of only 3 lakhs of rupees under section 10 AA. it is cash. Leave encashment is equivalent to the leave salary which that employee receives at the time of his retirement. Now, it's a beneficial provision to non-government employees. The government has proposed to raise this exemption limit of leave encashment from rupees 3 lakhs of rupees to 25 lakh rupees, a huge benefit to those employees which are going to get a leave encashment of up to 25 lakhs of rupees. It will be exempted and no tax liability will be there. If there would not been an amendment in this section, limit raised from 3 lakh to 25, and if anyone was in receiving, say, the leave encashment of 20 lakhs of rupees, then 20 minus 3 exemption is also 17 lakh rupees. He would have been liable to pay the tax. Now, this is a beneficial provision to non-government employees who are going to get leave encashment of more than 3 lakhs of rupees. Now, coming to the other provisions which are related to income from business and profession. So section 28(4), we know that it is a benefit or a perquisite which is arising from a business and profession. It is taxable as a business income in the hands of the recipient. These are the existing provisions that the value of any benefit or perquisites, whether convertible into money or not, arising from the business or from the exercise of profession, is chargeable to tax as a business income. Now, based on that, there were controversy judgments. In one case, CIT versus Mahindra and Mahindra Limited, wherein it was held that waiver of loan is in the form of cash money and thus it cannot be taxed under section 28(4). The judgment is in favor of the SSE. So in order to override such judgments and government want to tax such income, the proposed amendment is made by the government in this budget, wherein it is expressly provide that the value of benefit or perquisites arising from business, which would cover whether it is converted into money or not, or in cash in kind, or partly in cash or partly in kind, it will be chargeable to tax as a business income. The same amendment is effective from assessment year 24-25. So in other way, government has overruled the judgment given by in case of Mahindra and Mahindra. Now government will be getting an additional tax on such kind of perquisites or benefits arising from business, as it will be added back to the income of basic business income or the SSC. Moving ahead, we know that there's related to preliminary expenses which a company incurs before the commencement of business or after the commencement of business with an extension of his undertaking or connection setting up of a new unit. Now, earlier, what was the activity that in order to do the ease of doing business, what government has done that this is for amendment is be done as a procedural amendment only. Now, what they have proposed that the activity, what they are going to do, the SSC has to now file a statement of containing the particulars of this expenditure within such period and to such authority and such manner as may be prescribed. So, such amendments or provisions, that forms and everything will be prescribed by the government instead of other conditions when he has to propose. The main condition earlier, what was that for claiming the deduction of section 35D amortizes of preliminary expenses, the SSC was that work in connection with these activities should be carried out within the organization of the SSC, or if it is outside the concern, then the consent should be approved by CBDT. Without this, the expenses were not allowed as an expenditure to the SSC. Now, instead of going all these formalities, they have replaced by furnishing a statement with the SSC himself have to give the details, what all the provision will be there in the forms of that statement, which will be coming out by the government in the few coming times. So it is one kind of, we say, ease of doing business by the government for the SSC. Now, moving ahead, for certain deductions which are allowed on payment basis, section 43B of the Act, we know that there are conditions wherein if the payment of certain has not been made during that financial year, But however, it is made before the due date of filing of the income tax return, that payments will be allowed as a deduction as per the provisions of section 43B of the Act. Now, in that Act, some changes have been done only if we can say the categorization changes of NBFCs, where only the payment that clause D provides that interest payable on loan taken from a deposit taking NBFC or systematic important non-deposit NBFC shall be adopted as deduction. Now, these only two type of NBFC is covered for this section 43B. Others were not covered. So now, in order to make changes in this categorization, government has proposed to substitute that the two classes were by the class of such NBFC which will be notified by the central government. So when government will be notifying whichever NBFCs, this section 43 will be applicable or not applicable, that will be notified by the government. This is a procedural type of amendment, we can say for that. And similar changes are also been done for classification in section 43D of that. It is also similar with categorization of NBFC. Only two categories of NBFC were allowed for this. Now it has been also been substituted that it will be the NBFCs which has been notified by the central government in the official gazette on this behalf. This has to be considered. Now, beneficials to the micro and small enterprises. In our country, we know that there are many small and micro and small enterprises which are doing business on a smaller scale, and they have their own skills to conduct the business. And in order to provide them benefits, there is a special act been incorporated by the government, Micro, Small and Medium Enterprise Development Act 2006. In that, earlier, what were the provisions that if the companies who are purchasing or taking services of such MSME companies, if they're not paying the amount to them, then they have to be leviable interest on them, and that such interest was not eligible for deduction to them in the business head, and the same was been reported under audit report of that SSC. Now, still that was not been beneficial to the small and micro and small enterprises, because the companies used not to make the payments in time, and there was no funds available to such micro and small enterprises. So now what government has proposed by amending and introducing a new clause H in this section 43B, that any sum payable to a micro or small enterprises, now here concept on the word micro and small enterprises, whereas the act is micro, small and medium enterprises. Here the benefit is not available to medium and it is available only to micro and small enterprises. The provided any sum payable to micro or hello, I'm audible?
Yes,
hello?
sir. Yes, sir.
Yeah.
You are audible.
Payable to a micro or small enterprise beyond the time limit specified in section 15 of the Act shall not be allowed as a deductions. Now this provision, what it says, if the payment, whatever if there's a contract between the recipient and the provider, then it is the time period of 45 days. Within that, the amount has to be paid to that MSME. And in absence of any written agreement, the period is of 15 days only. The Act provides itself. That's the section 15. So now it is been that insertion of this clause, it is clear that it is allowed on accrual basis only if the payment is made within the time mandated under MSME Act and not under section 43BF of the Act. So it has to be considered. The provision which of 43B said that other payment if made on or before due date of filing of return is not applicable to such provisions of the payment made to micro and small enterprise. And it is provision, it has been clearly mentioned that this provision is not applicable to this Act for micro and small enterprises payment to be made. Now classification, just example, I'm in micro small enterprise as per the MSME Act, wherein for a micro, wherein investment in plant and machinery or equipment is less than or equal to 1 crore and the turnover is less than or equal to 5 crores, it is considered as a micro enterprise. And if the turnover is less than or equal to 10 crore and investment in plant and machinery equipment is less than or equal to 10 crores or turnover is less than or equal to 50 crores, then it will be considered as a small enterprise. And for medium enterprise, the limits in investment in plant and machinery are less than or equal to 50 crores and turnover is less than 250. But as we discussed, this benefit of 43B is not available to medium enterprise. It is only applicable to micro and small enterprises only. And this is applicable for manufacturing enterprises and enterprises which are entering the services. Moving ahead to other provisions of this budget impact, there are amendments in section 44AB which deals with the tax audit provisions. 44AD which deals with 44AD which deals with the presumptive basis of income the assessees who are offering business and income, and 44ADA deals with the presumptive taxations applicable to an individual HUF or partnership firm other than LLP engaged in 44AD is applicable to individual HUF or partnership firm other than LLP engaged in any business, whereas 44ADA is applicable to a resident individual or partnership firm other than LLP engaged in the specified professions. Now 44AD, when business who are in the business of commission and brokerage, 44AD is not eligible to them. That has to be taken into account. And 44AD is only for specified professions. So profession can be on an individual or a partnership one, but LLP are not eligible for this presumptive taxation. Now there was a monetary limit up to which the presumptive taxation benefits was eligible to those assessees. In the 44AD for business, the previous limit was up to 2 crores of rupees. The assessee was having an option to offer his income on presumptive taxation basis. But now this revised limit has been increased from 2 crores to 3 crores of rupees. So in that case, where an assessee is having his turnover or receipts up to 3 crores of rupees, is eligible to opt for this new taxation where he can offer as a percentage of his receipts to the income tax, and provisions of tax applicable will be same. And if he is opting for this 44AD presumptive taxation, there is also an amendment made in section 44AB where the assessee opting for this scheme, that tax audit provisions will not be applicable and he need not get his books of accounts audited. So similar provision has been amendment in section 44AD. Now 44ADA, we know that it is for the specified professions. The previous limit for the assessees who can opt for this scheme was up to 50 lakhs of rupees receipts only. Now the revised limit is enhanced to 75 lakhs of rupees. So up to 75 lakh rupees, the profession can go for scheme on presumptive where it can offer 50% of the amount as in his income of those receipts and pay tax accordingly as per the provisions of the Act. If the assessee is opting for this, similar provisions has been considered for 44AB tax audit provisions also. Now the condition is that whatever limit is been increased, there is one condition that the receipts in cash should not exceed 5% of the total turnover or gross receipts of the previous year. Now, say example, from 2 crores to 3 crores business income is there. So from the 3 crores of receipts, 5% we say, so 3 crores, 5% is 15 lakhs of rupees. That in cash, it should not be more than 15 lakhs of rupees. Then only the assessee is eligible to opt for this presumptive scheme with the limit of 3 crores of rupees. Otherwise, he is not eligible for this scheme. And similarly, in case of a profession, 5% of 75 lakh of rupees, that has to be eligible. It should not be more than cash of that amount. Otherwise, he is not eligible for that extended amount of from 50 lakhs to 75 lakhs of rupees. Now, for meaning of cash, it has to be considered that many times we have seen that SSE makes a payment to a person which is without an account pay doing. It is only cross and account pay is not mentioned. It's an open check. It can be transferred to other person. So such kind of transaction, if it's done, it will be considered to be part of that cash counting. And if it exceeds the limit of 5%, then again the SSE will not be considered eligible for that extended limit of 3 crores or 75 lakhs as the case may be. So that has to be considered by us. 1 second. Sorry. As I said, the amendment is proposed in section 44AB also to give effect to the proposed amendments in section 44AD and AD. So if SS is opting to file under presumptive scheme, then tax audit shall not be required in case of such SSEs. Now moving ahead to other head of capital gains. Capital gains, we know that section 54 and 54 are the exemptions provided by the Act in case to an individual and HUF where they are getting a capital gains from transfer of say residential property. Then if the amount of capital gains is invested in a new house property within the prescribed limit, then the SS is eligible for exemption under section 54 and no tax is paid on that. And for section 54F, if any long-term capital asset is transferred which is other than a residential house, then the SSE, if he invests the net consideration into a new house within the prescribed limit, then he is eligible for a exemption of that income under section 54F, and there is no tax liability to be paid to the paid by the SSE on such transfers on the capital gains incurred. It was a very beneficial provisions to the SSE for under section 54 and 54F. But there is at present the provisions, there are no threshold limit of the maximum amount of deductions for which a SSE is eligible. So what is to be done, the high net worth SSEs, what they should do, those sell a property at a higher value and by making investments as per the section 54 and 54F, they don't pay any taxes to the government. Even though if there's a huge capital gains to them, but due to beneficial provision of 54 and 54F, the tax planning was possible and no tax was being received by the government under this. So if examples if you take for that, this is applicable amendment that to restrict such exemption will came by high net worth assessees by purchasing very expensive residential houses. There is proposed to that maximum limit to be curved of up to 10 crores of rupees only. So now there is a threshold limit being proposed in this budget. A maximum benefit which an SSE can get under section 54 and 54F is restricted to 10 crores of rupees only and not more than that. It is individual for both the sections. It's not a combination of both, and it is applicable from assessment at 24-25. So if any asset is sold from 1/4/2023 and onwards, then this restriction of 10 crores rupees will be applicable, and any income on more than 10 crores rupees, the tax is to be paid on the difference amount by the SSE. If you have seen that by way of making tax planning, budget was proposed on 1st of February 2023, and till a few days back, I'll just share that for making of planning of tax savings, 3 major transactions have been entered in the residential property market. Just I will provide a detail, even it's not relevant, but how the people are ready to make planning before 31st of March 2023. A DMart owner, you know that Radhakrishna Damani and others, they have purchased property worth 28 units in a bulk deal of 1,238 crores of rupees. And another Welspun Group chairman, Mr. BK Goenka, he purchased property for 230 crores of rupees. And recently, Neeraj Bajaj, chairman of Bajaj Auto, he purchased property of 252.50 crores of rupees. So if they all came to know that after 1st of April 2023, the benefit will be restricted to 10 crores of rupees. So it might be to get this benefit this year, time some tax planning might have done and they are incurring such huge transactions of properties. So government might whatever thought that in future will be get a tax about 10 crores of rupees. Their planning is been done before 31st of March, the maximum they can do for them. Now moving ahead, there are certain transactions which are not considered as a transfer under Income Tax Act and they will not chargeable to tax. The section 747 of the Act, Income Tax Act, provides for this list. Now we all know that in India we have a tendency of holding the gold and that too in physical form. It has been said that gold is there in future where there is no bad times, it will be helpful to the families and etc. So everyone in the family holds gold in physical format and not in the other formats. Say now like shares we have in demat or electronic mode, gold are not been still in physical format only. So now in order to promote such holdings of gold electronically or digitally, government is come out with the provisions to be inserted in sections 47. A clause 70 has been added that whenever this gold is to be converted from physical mode to into electronic gold receipts which are issued by vault manager, then it should not be considered as a transfer. And if it's not considered transfer, no capital gain shall be leviable on such conversions also. So this is a beneficial provision, though at least people will come forward and go for the otherwise. If the such conversion from physical to electronically gold would have been considered as a transfer, then it would taxable to tax capital gains. Then no people will come forward to go for such conversions. So this is a beneficial provisions. And similarly, in future, when if you want that gold into physical format, if you convert from electronic gold to the physical gold, then also it will not be considered as a transfer, as and hence no capital gain will be leviable on such conversion also, because you are not selling that, you will only transferring that into physical format and holding with you. So it will not consider as a transfer and no capital gains will be applicable on such gold. So by this provision, government wants to people to come forward and keep the gold in electronic mode and not in the lockers or in the rooms. Now, moving ahead, we know that whenever there is a capital gains, there is a deduction available for the cost of acquisition. Section 49 of the Act, it deals with the cost of acquisition when the conversion is and the property of the assessee in specific cases is been transferred. So it is some various, if I am getting some property from my forefathers or from Ligaras, or then now government has come up with conversion from physical gold to electro gold. So in order to work out what is the cost of acquisition, they have also proposed to add a new clause in section 49, wherein it says that when in the gold is converted from physical into electronic gold receipts, the cost of acquisition of the electronic gold shall be deemed to be the cost of the physical gold. That means, see, if I have purchased the physical gold say 10 years back, okay, and today, then which scheme is become in April, May or June 2023, I want to convert into a electronic gold. So at that time, the cost for that gold will be the cost which I have purchased 10 years before. That will be the cost of acquisition, and not the cost on the date of conversion of say in June 2023. No, it will be my the actual cost for purchase 10 years before. And also similarly, in the event of conversion of uh, electronic gold into physical gold, The cost of acquisition of the elect will be the cost of acquisition of gold only, because in above we say that if I am converting it from to EGR, the gold cost will be back 10 years back only. And now if I am from EGR also converting again gold, the my cost will be same only whichever purchased. It will not change my cost as on the date on which I am considering this conversion. It will be back to my old gold purchase only. Now moving ahead to how this capital gains will be taxed as a short-term capital or a long-term capital, and that depends upon the period of holding of the asset. As we know that is whether it is a short-term capital gains or long-term capital gains, we have to consider for that, and the period of holding has to be determined. So section 242A is explains that what constitutes a short-term capital assets and provides a period of holding for certain specified assets. In this case, where the listed equity, etc., are holded less than 12 months, it is considered as a short-term capital assets, and other assets which are held not more than, in other cases, it is not more than 36 months, then it is considered as a short-term capital assets, like units in a mutual fund, etc. Now, it has been proposed that the period of holding for such conversion of gold before conversion into EGR. So if I have purchased 10 years before, okay, and I'm converting that bond physical gold into EGR as per our example to May to June 2023. So my holding period will be included from the period when which I have purchased that gold, that is 10 years back. So that 10-year period will be considered, and since it is more than the period as mentioned in 242A, it will be considered as a long-term asset, and the taxation will be based on the long-term capital gains. Similarly, the assessee holds the gold into EGR before converting the same into gold again. The period of holding the gold from that 10 years will be considered as a holding, and not only the period from which I am holding that EGR conversion. So that has to be beneficial provision, and then no tax has to be paid for the assessee on such conversions. Now moving ahead to deduction of for interest on housing loans, it is to be considered. All we are aware that as an assessee, we have been purchasing properties and taking the loans from banks and financial institutions, and deductions for eligible interest on housing loan is allowed under section 24B under income from house property. So that beneficial provision, and people used to get benefit for reducing their total income also. The tax liability will be reduced, and they are already getting a purchasing a new house property with them. So now, in case it is considered that interest, now section 48, it provides the method for computation of capital gains, wherein we know that deductions of cost of acquisition is or improvement is allowed from the full value. Say example, if I'm selling a property is 10 crores of rupees, and I have purchased it at 5 crores of rupees, and so my deduction of 5 crores are allowed subject to indexation cost, then balance amount will be allowed as a capital gains. But in such many cases, the assessees, what they used to do, they used to claim deduction of interest paid on borrowed capital under section 24B of income from house property. And again, while computing capital gain on transfer of such properties, they used to consider his interest on the borrowed capital paid as a cost of acquisition, and claiming double deductions from the income. And there was no such provisions which was restricting to do such things. So what government did, there was a beneficial provision to the assessees, and they were taking the double benefits, claiming interest deduction also and cost of acquisition also. So now, in order to prevent these double deductions, it is proposed to insert a provision that section 48 shall provide that the cost of acquisition or the cost of improvement, it will not include the amount of interest claimed under section 24. So when I am claiming that our interest as a deduction under section 24B of VAT as an income under that house property income, I will not be eligible to consider as a cost of acquisition, and no deduction for this will be allowed. So this is bill beneficial provision to the government and not to the assessee. It might lead to increase in more tax revenue for the government for this. So double taxation benefit is now been taken away from the hands of the assessee by providing specific provisions in the act itself. Further, we can know that there were certain intangible assets wherein there was a condition that capital gains has to be considered as per section 55. So what has to be considered as a cost of improvement and cost of acquisition to compute tax on such self-generated intangible assets or rights. There has been many companies have developed rather such intangible in-house, so there is no consideration has been paid by them. So various courts have been given the judgments that computation of capital gains for such intangible assets cannot be made as there is no mechanism available since the cost of those asset is not there. So there was no possibility of computing that capital gains, and all those judgments were in favor of the assessee. They were not taxable to computation gain, even though the amount was in big amount. So in order to overcome these decisions given by the courts, which were favor of the assessee, and the government has proposed to amend the provisions of section 55(b) and 50 so that the cost of acquisition and the cost of improvement, all the self-generated intangible assets shall be taken as nil. So now government has specified a mechanism that all these costs will be considered as nil. So now there they provided some kind of mechanism. So your intangible asset selling say 1 crore rupees, my cost is nil. The balance is capital gains of 1 crore rupees, and now it will be taxable and tax has to be paid to the government on these assets. So this is a revenue will be generated by the government by making amendment to these provisions and overriding the judgments given by the courts in the favor of the assessee. Now it is overturned. Moving on to further provisions, capital gains taxation on transfer of market linked debentures. We all know that market linked listed market linked debentures, where there is a period of holding it exceeding 12 months, it is considered as long-term capital gains and without taking the benefit of India taxable at the rate of 10%. And where the period doesn't hold in 12 months, as we discussed, it is considered as a short-term capital gain and taxed at normal rate applicable to the assessee. So if I am at say 30% tax on my short-term capital gains, the amount will be taxed at a higher rate. And if it is long term, it is beneficial to the assessee. It will only 10% without indexation benefit. Now, in order to make the amendments, and government wants to increase the taxation amount from such kind of transfers, the new section 50AA is inserted, wherein the transfer of such market linked debentures will be considered as a short-term capital gains on irrespective of the period, even if my holding is more than 12 months, say up to 24 months, 36 months, but this provision is such that it will be considered as a short-term capital gains only, and the rates applicable as to the assessee at normal umbrella. So this is not a beneficial provision for the benefit of the assessee, because now will be paying higher amount of tax as compared to tax 10%, which would have been paid if it would have been considered as a long-term capital gains. So it will be a revenue addition for the government and loss in case of the assessee. It is also proposed that market term linked debentures to be defined as a security with an underlying principal component in the form of a debt security, and where the returns are linked to market returns or underlying securities or indices. Also, they said that while computing these capital gains, the securities transaction, we know although that we are dealing in share market, online stock exchanges, there is a security transaction tax applicable. So while computing this capital gains, the deduction of these security transactions is not allowed. So it is also again to increase the difference of capital gains in the hands of SSE, and they are going to pay more tax to the government. Moving ahead, for the meaning of consideration in joint development agreement, there are the provisions in the Act under section 45(5)(a), where then SSE as an individual or HUF who enters into a joint development agreement with the builder, it will be deemed that the capital is transferred during the year in which competent authority issued the certificate of completion for the whole or part of the project. If I am today agreeing with a builder for joint development agreement of property, and the completion certificate of the project is after 3 years, then after the 3 year in which certificate it will be as a capital asset is transferred in that particular year. And for computing the capital gains from the full value of consideration, what was to be considered? It was considered as an aggregate value of the stamp duty value of the SSE share in the joint development property, and any additional consideration that was received in cash. Say example, consideration is taken that in joint development the SSE is getting say 15 flats from the developer, plus say 30 lakhs of rupees in bank by check or online payment, and the stamp duty valuation of all those 15 flats, say it is amount 15 crores of rupees. So 15 crore rupees in that value, stamp duty valuation, and 50 lakhs rupees what is issued by check will be considered as a value of consideration for the capital asset, which is SSE is transferred as an individual or an HUF to that by way of joint development agreement. However, there were determining the value, there was an argument that the amount which is received by banking channels, it cannot be considered as an amount of consideration received in cash. They were arguing that cash means the actual cash, and hence they were not forming part of the consideration for taxability working. So there was a loss of revenue to the government, even though the amount was received by banking channels in crores of rupees by the SSE. It was not forming part of value of consideration because they said it is mentioned in cash, and cash does not include bank or other mode of payment. So there was an ambiguity for such. So in order to curb this ambiguity and the government to want to earn more revenue from such kind of transactions, it has been clarified that for computing the full value of consideration, the consideration received by check or draft or any other mode shall also be included and be part of amount of consideration along with the stamp duty value of that SSE share. So now this has overcome by the government by making amendment to this provision. So now, while considering the consideration value of that sale of that property by JDA, the stamp duty value of all those property which is going to receive, plus whatever amount is received by either by check, draft or any other mode, will also be added back to this consideration, and that will be considered sales value, full value, and not only the stamp duty value. This is a beneficial provision from the angle of the government. Now the sales considered will be increased, and tax amount will be more as the capital gains will be more. Sales kind of sketch with clarification in nature, and more tax to the government will be eligible. Moving on to other source of income, section 56(2), there's a provision made by Finance Act 2012 to prevent the generation circulation of unaccounted money through share premium received from resident investors in a closely held company. Now what earlier the kind of closely held companies in which public are not interested, they used to issue shares to other persons, the residents, and the premium amount was to be huge. It exceeded the fair market value of shares also, and it was not considered as an income head also. So in order to curb these provisions, section 52(7)(b) was inserted, but it was only applicable to the resident SSEs if the amount is received from a resident SSE. But non-resident, such provisions were not applicable. So after this amendment was done, the people used to now issue shares to non-resident SSCs investors and get a premium amount from that. So as we said, it was not applicable to the non-resident. Now government came to know about these provisions, and now it has been brought an amendment to this clause to make that share applicable money received or premium received for any person, regardless of their residential status, it will be considered as an income from other sources in excess of that face value and taxable in the hands of the recipient. Now this is effective from assessment 24-25 onwards and subsequent assessment years. So this applicability is there from the next year. Now moving at some received from business trust to taxable. We all know that government has come out with real estate investment trust and infrastructure investment trust. They are known as a business trust, wherein what they do, they get the amount from investors and they make investments in real estate projects and infrastructure projects, and whatever income they earn from that, they share to their investors. Now what they do, that they are already be given that pass-through tax status regarding income such as interest income or dividend income received from a special purpose vehicle and rental income from the properties which they are directly owning. Now this income is taxable in the hands of the unit holders and is treated as being of the same nature and proportion as received by the trust. So whatever the income these RITs or investment trust transferred to the unit holders, it was taxable in their hands. That are present provisions. Now, what government has done to that the board, there was some tax planning going on by these REITs, business trusts. What they used to do avoid tax, they used to transfer the income to those unit holders by way of repayment of debt. So if that it is a capital amount that is paying, so there is no taxation suffer either in the hands of the business trust or in the hands of the unit holders. So government used to not get any tax on this amount. So government came to know that this method is been followed by business trust to avoid taxations. So in order further to such strategies, finance bill has introduced under that any sum received by a unit holder from a business trust is not in the form of interest or dividend form as SPV or rental income will be considered as a unit of income of the unit holder, and it is not taxable in the hands of now. Such repayment of debt can say whatever been was to be done as a business trust to avoid tax. Now such income will be taxable in the hands of the unit holder by the amendment made in these provisions. So now this tax evasion or tax planning is being curbed, and government will make revenue from this amendment. The sum received by unit will tax as an income from other sources, as we decided. And further it is said that if such sum is received on account redemption of units of business trust, the cost of acquisition shall be allowed to be deducted to the extent of sum received. So whatever cost that unit holder has paid for acquisition of those units, LPD allowed as a deduction, and the net amount difference will be taxable as income from other sources. However, if the unit holders has been incurred any losses from such redemption, then such losses are not allowed to be claimed by the SSC, and there is no benefit for the SSC in such scenario. Moving ahead, the other provisions related to life insurance policies. This is also one of the major amendments made by the government for life insurance policies. We all know that life insurance policies, the different terms, there is a term policy, there is an endowment policy, and there is ULIP policies. Term policies means we all know that we don't get any amount in term policies at the time of maturity. It is only a security of a life insurance on the death of the SSC insurer. The person is covered. The nominee will get the amount and it will not taxable in the hands of the recipient. Otherwise, on maturity, the assessee himself doesn't get any amount. Endowment policy is a combination from of savings, investments. He gets the amount at time is maturity along with the bonus and etc. and which is exempted under section 1010D as current provisions. And we all know that whatever premium payable to the any years, it should not exceed 10% of the actual sum assured. Then only you will eligible for exemption under section 1010D. Now, under ULIP policy, there is a monetary cap of 2,50,000 rupees, which have been brought into Finance Act 2021, and the limit of 10% of sum assured is already. But for endowment policies, there is no upper limit up to whatever amount they were issuing at the time of maturity. It was exempt under section 1010D. So high income people, what used to do, take higher premium policies, and on the maturity there are crores of rupees, and there was no tax available because the exemption was provided to them under section 1010D. So in order to curb this misuse of exemption by high net worth individuals who invest in large policies with large premium contributions and claim exemption, many changes have been proposed by the government through these provisions of the budget. Now, a monetary policy is proposed to be proposed on life insurance policies which are issued on or after 1st of April 2023. In such cases where the premium payable for any year during the term of policy should not exceed 5 lakhs of rupees. If it exceeds 5 lakhs of rupees, no exemption will available under section 1010D. However, the 10% premium of sum assured is also applicable. So this has to be taken care of. The government wants that high premium life insurance policies who are taking huge benefits of them. There's a restriction of them, and they should be taxable, and government should get some revenue from such person earning income from making investment in high premium life insurance policies. So now, also it is provided if premium is payable by person for more than one life insurance. The exemption shall be available only for those insurance policies where aggregate of the premium does not exceed 5 lakhs of rupees in any of the previous during the term of those policies. However, the provisions applicable, whatever we discuss above, is not applicable if the sum is received on death of a person. Even if the premium is more than 5 lakhs of rupees, but the amount has been received at the time of death of a person, then this provision will not avail. It will be exempt under section 10D.
Learn that first.
Government now will be receiving high tax from such high income assessees who are paying premium of 5 lakhs, and in case assessees, or I can say other way around, whether it will affect the business of insurance companies. The people will stop buying high premium insurance by way, since it is taxable now in the hands of the assessee for the amount. Now we can further what it said as the sum, what provision is made, the sum received from insurance policies it's to be considered as an income except ULIP and key man. ULIP, I have already said that the cap of 2,50,000 is already there, and key man insurance policy is already taxable in the hands of the SSC. It will be considered as an income from other sources. Now, first, what was the issue was that the section 224, which defines income, there was no provision in the act that amount of received under such policies was considered as an income. So proposed amendment has also been made by the government in section 2 subsection 24 that such amount received under life insurance policy will be considered as an income. Further, amount which is received by SSC under ULIP insurance, it is considered as a income as capital gains and not other source income. And other endowment we have also told it is not any receipt is going to get at the time of maturity. So what taxable income, what government is with the amounts or received as exceeds the aggregate of the premium paid during the term of. So at the time of maturity, say I am receiving say 10 crores of rupees, and the premium what I have paid, it is near about say 1 or 2 crores of rupees. Then it will be added as deductions, and balance amount will be considered as an income from other sources, and income taxability working will be done accordingly. However, further it is said, if the associate claims such deductions in any provisions of the Act, say if we are paying a life insurance premium, then we claim deduction under section 80C, then such premium will not be reduced from the amounts or received. Double deduction will not be allowed if I am claiming deduction under 80C of the Act as premium deductions. Again, I will not allow to reduce from this amount received at the time of maturity. And government also prescribed that competition mechanism will be provided for computing income of such life insurance policies receipts. After taking into consideration all the provisions of taxation of income heads, we move ahead to the provisions of TDS and TCS. TDS and TCS, we all know that it's one type of provisions which have been added by the government to get the data of the transactions being entered, and not by way of any tax, because the asset is going to get the credit of the same by way of crediting his tax liability. Now, for this section, 206 AB and CC provides for deduction and collection of tax and highest. Hello. Hello. Request to mute someone. There's disturbance going on. Am I audible? Hello. Hello. Am I audible?
Yes, sir.
There's a disturbance going on. Some mic is also open. Screen is also visible, no? Properly?
Yes, sir.
Now, there are the provisions in 206 AB and CC where the higher rate of tax was applicable to those persons where disturbance in the background. Now, am I audible?
Yes,
Hello?
sir.
Yeah, thank you. This provision is not apply to non-resident who does not have a permanent establishment in India. So now it is proposed that government that the person who are not required to furnish return of income and which will be notified by the government, these provisions of higher rate of tax of TDS and TCS will also be not applicable in case of those SSAs which will be notified by the government and those who are not required to file the return of income. Now, increase in rate of TCS on certain remittances. There are certain remittances to be made by country from here to outside country when the TCS provisions are applicable. The section 206C of that provides for such provisions. When we know that there's a liberalized remittance scheme also available, the tax rates at present what were applicable with that, and when in foreign tour, the packages rate was only 5% without any threshold limit. TCS rate was applicable, And in case of foreign remittance, other than education and medical purposes, it was 5% of the total amount in excess of 7 lakhs of rupees. And for if the remittance was made for education, whether it was made by obtaining loan or other than loan, in case of loan, 5.5% of total amount in excess of 7 lakhs TCS was applicable. And in case the loan other than loan, 5% of the total amount in excess of 7 TCS was applicable. Now government has made an amendment to two provisions for applicable to overseas tour packages, where the rate has been increased from 5% to 20% without any threshold limit. So now, so on a lighter note, we can say that if anyone, and these provisions are applicable for 1st of July 2023. So if we say that if you want to plan any tour package for an overseas tour, it is better you go before on or before 1st of July 2023. So you have to pay less TCS amount, and the amount blocked for 1 year will be lesser amount by 15%. Further, TCS on foreign remittance under liberalized remittance scheme, other than education, and it is also increased to 20% without any threshold limit. Where the earlier was 5% with threshold limit of above 7 lakhs, 5%, and now it has been flat 20% on that amount. So the amount what the people are going to sell now, it has been going to. I think that government has made this provision of increment of rates in order that they might have found that by paying 5% also, people were not filing income tax returns. What will be the reason? So if government gets a revenue of 20%, if they want to claim a refund, they will either file a refund or government will get the share of 20%. This will be revenue for the government generation if the assessee don't file the return and claim the refund. Moving with the other provisions of TDS, section 192, where the payment of PPF is done by the assessee. It is said that there is no TDS applicable if the amount of withdrawal is less than 50,000 of rupees. Similarly, the provision says that if it's about 50,000, then 10% at the time of withdrawal of accumulated rate is applicable. However, the assessee is not providing PAN, then the TDS at the rate of maximum marginal rate was applicable. Section 206AA that provides that rate that it will be the rate specified in the relevant provisions, rate of tax in force or the rate of 20% applicable. But it is promoted to remove the second provision in case of non-PAN submitted TDS at the MMR applicable. So what the MMR rate applicable was 30%. So in order to give relief to that persons of EPF withdrawal who are not having PAN, the rate proposed is only of 20% in such of cases when they are not able to provide PAN to the assessees and not 30%. Further, points of 194BA, TDS on net winnings from online. We have seen that the special section has been made by the government for taxation of online games. And similarly, new TDS section has also been inserted 194BA to deduct TDS and the net winnings in the user account at the end of the year. So now it is applicable to the person responsible for the paying. We know that a lot of online games are being played by many persons and no proper taxability was being solved. So these provisions had been made to tax the withdrawals of such income from winning games, net winnings. So now it has been proposed that where the net winnings are actually in kind or partly in cash and partly in kind, but cash payment does not enough to cover the tax liability, the person responsible for making paying that must show the tax has been paid on the net winnings. See, at the end of the year, when it come to know that a person has been earning income from online games, when making payment, the payer has to determine that he has to either the amount is sufficient to deduct the tax at the applicable rate, which is 30% on such kind of incomes. And he has to deduct tax. If a cash amount available with is sufficient enough, then he has to deduct that tax and make the net payment to the recipient. And where in cash there is no availability of amount available in his balance account at the end of the year, because this provision apply at the end of the year. So on that case, the payer has to make confirm that the tax has been paid by on that winnings by the recipient. Otherwise, he will be liable for penalty and everything. Government is also going to come out for the mechanism for calculating net winnings. The rate of TDS applicable on such is 30% when it is applicable from 1st of April 2023. So now government say claim whatever you earn, higher in your earning, the government will get a flat rate of 30% of tax. We say that new section 115 BBJ as we discussed. It is if an individual is in total income is includes any winning from online games, the tax payable shall be combination of the 30% of net winnings from online games and tax payable on his total income as reduced by the net winnings from online games. So the 30% is flat, irrespective, no deduction, everything available, eligible to the SSE. Government will get a net rate of 30% from the SSE, and this will be income beneficial to the department. They'll flat reward. As in lotteries, and we have seen that flat 30% is in taxes eligible to be paid to the government without any other deductions available. Now further, section 193, we see that interest on securities TDS, where the securities are held in dematerialized form and are listed on a recognized stock exchange. There was no TDS applicable in the present act. However, if the government want to now have a detail of this act, and it's proposed that TDS at the rate of 10% will be applicable on such interest also. (194)(b) TDS on winnings from lotteries and games. Present provisions what is said that deduction is applicable at the rate of 30% TDS on income from lottery, crossword, puzzle, including horses, card game, and any other game of any sort of an amount exceeding 10,000 rupees. So the provision was not clarified. The 10,000 is applied for each transactions or the total aggregate amount during the year. So when the payment was been done, they were considering as each transaction limit of 10,000 was applicable. So if the amount was less than 10,000, the TDS was not been deducted. So in order to clarify this, amendment is made that if the amount of aggregate amount exceeds rupees 10,000 during the financial year, then the TDS will be applicable, and it is this amendment is effective from 1st of April 2023. So any amount paid after 1st of April 2023 and aggregate is exceeding 10,000 rupees in during the financial year, TDS at the rate of 30 payable, and not to limit applicable is not to individual transactions. Now, since new provision of 194BA is introduced for TDS on online games, net winnings from online games, the second provision in 194B, it excludes now TDS winnings from online games, because in that the provision we see that it mentioned other games. Earlier TDS was provided in this section. Since online games specified provisions has been amendment in section 194BA, the provision from this is deducted, and online games will taxable and TDS applicable on that section or not under this 194B. TDS on cash withdrawals. There are provisions in the Act that when the TDS is to be deducted in cash is withdrawal is made in excess of 1 crore to any person by banking company, cooperative society, engage in banking or post office. The 2% rate of TDS was applicable. But in order to the cooperative societies, we know that many cooperative expenses are in cash major. Farmer society or many other type of societies are there. So in order to having a working capital with the more, the government has raised the limit from 1 crore to 3 crore in case of cooperative societies only. So the TDS applicable with only if the cash payment exceeds 3 crores of rupees during the year, then only TDS is to deduct 2%, otherwise not. So indirectly we see that if the society is withdrawing of cash of say about 3 crores of rupees, so TDS is not applicable. So 1 crore to 2 crore, 3 crores, 2 crores of amount, 2% if would have been deducted, it would now is saving in cash in hand. It can helpful as a working capital for the cooperative societies. Now moving ahead with certain other provisions of TDS 196A. Present provisions that any income paid to non-residents in respect of units of mutual fund, 20% TDS rate is applicable. Whereas we know that there has been certain treaties with the government with other foreign countries where the prescribed rates of the incomes are lower as compared to the applicable rates in our country. But these provisions were not applicable in section 196A. The amount flat 20% rate was applicable to make to be deduction as a TDS. So in order to provide the benefits of the treaty with other countries, what government is to ensure that TDS is now made at lower rate or the rate prescribed in the tax treaty, whichever is lower. So relief is only eligible to the taxpayer for relief under this tax treaty. If my tax treaty is applicable to that SSE with a foreign country, say I am having a tax treaty with Singapore, the rate applicable in my treaty is lower than 10% of such income from units of mutual fund. Then the rate of TDS applicable with 10% and not 20%, as these amendments has been made by the this finance bill, and the same provisions are applicable for 1st of April 2023. And one more thing is that the SSC has to provide the tax residency certificate also for this to take the benefit of this lower rate of TDS. Now moving ahead to provisions related to charitable and religious trust. There are major amendments in charitable and religious trust also, but we'll go through the because it will take more than 1 hour to cover all those things. But a few importance which will be done. Earlier, we know that a charitable trust and a religious trust, they have to utilize the 50% of the amount eligible donations for the purpose of their what they have been formed for, and 15% they can transfer to corpus, and they came the benefit of exemption under section 11. But now what the trust used to do, I am say a trust is from ABC. They received some 100 rupees from as in donations, and out of that what they do, they pass on 85 rupees to another trust, and they claim that 85% of this amount, 85 rupees we have utilized for our specific purpose for these charitable and religious activities, and claim the deduction under section 11. Now another trust which received that 85 rupees, what they used to do, other further move at 85% of that amount to another charitable trust, and so on and so forth till the down. And officially the benefit was to be that the 85% of the 100 rupees, 85 rupees used to be utilized for the purpose of charity, whereas when it goes down to layer of various trust, it goes down the line, and amount what which is below 85 rupees, which is utilized for the actual charitable purpose. So now what government has come out that, so in order to that 85% of the amount will be eligible only to another trust will application. So what further 85% is not at the, what if the amount is received by other trust, they have to utilize that full amount for the charitable purpose and not reducing that of, so 85% is to be capped. And further it has been you know that section 139(8)(a) was been inserted by Finance Act 2022, wherein a provision was made and uh, updated return of income was allowed to be filed for the necessities where whether or not such income filed the original, belated or revised return or the relevant assessment year or not within 24 months from the end of the relevant assessment year. So 139 it speaks of a updated return. Now what government has said that the trust has to file this return under section 139(4)(a). So in case the to claim exemption under section 11 for exemption, trust has to file that within the time limit. Now there was a query that whether the updated return can be filed by the trust and benefit of exemption can be claimed. So government say that no, this benefit of filing an updated return of income will not be applicable, and no deductions will for getting the claiming exemptions of income tax. Trust has to file the returns within that time limit as applicable, and no benefit of updated return can be applicable to the trust. Further provisions related to filing of due date of forms 9A and form 10. We know that form 9A, it is a report of the amount which cannot be utilized, is accumulated and transferred to the corpus, and form 10 deals with the report of the amount which cannot be utilized, is accumulated and can be utilized within 5 years. So there was a clash of timing of filing these forms and return. So auditors will be not able to work out on that. So if form 9A and 10 were filed late, then exemption under section 1023 were not applicable. So in order to prepone the due date of filing the due date, it has been that it has to be before 2 months prior to the date specified under section 139(1). This form 9 and 10 has to be filed. So just summary of that provisions that if a return filing ITR for trust is 31st of October and the filing of audit report in form 10B and 10BB is 30th of September, then form 9A and form has to be filed before 31st of August. These are the provisions of the summary which are proposed to be amended. Now prosecutions and penalties. Section 271 FAA provides for a penalty applicable for a default conducted by the person furnishing the statement of financial transaction. There are certain provisions made where the persons are liable to file statement of financial transactions, and not adhering to this provisions, penalty of 50,000 is applicable. But such provision of penalty is not there for if the account holders who furnish the details to such persons for furnishing statement of financial transactions, do if they're providing any false certification or information. Now there is a proposed amendment to levy a penalty of 5,000 for every such inaccurate reportable account, and this amount is to be paid by financial institutions to the government. However, the financial institutions are allowed to recover the same from the account holder. As I am an account holder, I provide any incorrect or falsified information to that person, and based on that, he's been levied penalty of 50,000 plus 5,000 based on me. Then he can record that 5,000 amount from me and pay to the government. Further, penalty of under section 271C and prosecution 276 will be launched in case of deductor fails to ensure that tax. We have seen that 194R TDS on benefit or perquisite in respect of TDS is applicable, 194S for virtual digital transfer of assets, and 194B TDS. If the payer does not ensure that tax has been paid on this income, then he will be liable for penalty and prosecution both. These are applicable with effect from 1st of April 2023. Further, moving at for exemption deductions provisions applicable in the budget. Section 1022B, it provides for exemption to income of a new notified news agency in India, subject to fulfillment of certain conditions. Government has made an amendment that now this exemption is not to be provided to them, and so this exemption of section 1022B is withdrawn. Now government will be getting revenue from such news agencies who will be filing tax of returns. As the exemption none, then income will be taxable. So beneficial to the government, revenue will be shared. Further, as an SSE, we used to make donations to various charitable trusts to claim deduction under Income Tax Act, so that our tax liability, income is reduced and tax liability reduced. But there were certain name-based funds for where ATG was eligible. Thus, government has removed those name-based from the list of eligible donee. Jawaharlal Nehru Memorial Fund, Indira Gandhi Memorial Trust, and Rajiv Gandhi Foundation. Now, if an SSE, if I make a donation to this trust, then I will not eligible to claim deduction under section 80G. It is applicable for assessment at 2024-25. Further, there are also provisions for redundant provisions removal. Section 88 is also removed because 88 earlier LIC premiums contribution to PF etc. were eligible under section 88. Now, since all these deductions are eligible under section 80C, section 88 has become redundant, and there is an amendment to delete this section itself. The section has been removed. Now, relief to sugar cooperative societies, assessments related part I have been covering for last few minutes. That earlier there was a dispute that with effect from assessment of 1617, the sugar factories for sugarcane purchase were allowed as deduction of an amount paid equal to or lower than the price set as approved by the government. But there were an issue before this period, assessment at 1617. What about the amount paid before that period? So additions were made in such a case of such assessments, or the matter has been going on in litigations and etc. So in order to come out with this and make a beneficial provision to the cooperative sugar factories, it is proposed to allow deductions for sugarcane purchase expenditure equal to or less than government fixed price for the previous period also. And for this, SSE did not apply for the previous period to be done. Now it is a beneficial provision to such kind of SSEs of sugar factories, and government will get a hit on revenues from the same. Now, before I conclude this sheet, after going through all those important provisions which I have considered above, and taking the receipts of other tax by the government, estimation of the tax receipts, the below what in the screen is net tax receipts. Revised estimates for 22-23 by government was 20.9 lakhs crore rupees, and these estimates for 22-23, 23-24, government had estimated of net tax at 23.30 lakhs. So there is a differential of increase of revenue, but net tax benefit 2.4 lakh crores rupees. Even after making such amendments, so if we come to know this receipts I am given is as per the budget provisions. It includes not only direct tax but indirect tax, customs and GST also. So it is not for direct related to direct tax only. So normally it is an increment of revenue for the benefit of the government. They will be giving a good amount of income revenue. They are estimated based on this. If all those provisions fall beneficial for the government. So now with this, I conclude my session. I once again thank you to WRC and Nirmala Foundation College for giving me this opportunity to share my knowledge on this subject, budget impact of taxation. Thank you very much. Okay. Thank you very much. Thank you very much. Thank you. Thank you very much.
Thank you. Thank you.